Because it certainly seems what was at the beginning was not what it was at the end.
Sure did. It kind of turned into a Lucy and Charlie Brown in the football sort of a deal. It throws out there that he's getting mindful of the tightening that's already gone past and respectful of the fact that there's lags in monetary policy, and that sort of created a little bit of a party. You had a big rally in the 2-year Treasury yield went down and stocks went up a lot, and then the presser comes, and it's kind of like old times when the presser comes out and all of a sudden the message starts to get sculpted a little bit differently. So he sort of contradicted himself. You know, he sounded kind of dovish with sort of a, we've tightened a lot already, and then suddenly it's what we think rates are going to go higher than we thought before, and kind of put the kibosh on the idea of anything resembling a pivot, a plateau of quite some time. And I think that really was intentional to kind of, people said he had to thread the needle. He kind of like straddled the problem rather than threaded the needle.
We were watching it at the same time. You did think that it was significant that language was put into the statement, the language of we'll consider the cumulative effects and the lag effects of what we've done to this point. And that was the dovish message. You thought it was important that it was in the statement.
Yeah, I mean, it's quite a shift from we need clear and convincing evidence, which were statements prior this year. And he put this one in, I think, to just show that he's mindful of the fact they've gone a long way. You know, Scott, I was very critical of the Fed back in May. I thought they were way behind the curve. I've kind of somewhat facetiously said they should raise rates 200 basis points and then see what happens. But they've kind of done that. And they were miles behind the message of the bond market. And now they're pretty much getting beyond the same block as the message from the bond market. And so I think that he's trying to make sure that he's not just perceived to be on a scorched earth path.
The real question is, what do they do from here? What should they do from here?
I think they're going to do what they should, because when I glue these statements together and try to figure out how they can be consistent with each other, I think what Powell said without saying it out loud is we're not going to raise 75 at the next meeting as a base case. I think that's kind of what he meant by we're respecting how far we've gotten. We know that there's lags. So I think we're probably going to get them slowing down. And the bond market has basically got the 2-year Treasury at 450. And that's kind of, they're talking about 425, 450. So they're pretty in sync.
Larry Summers tweeted yesterday to the suggestions that the Fed should either slow down or pause very soon. He said it's, quote, badly misguided. On balance, given its past errors, the Fed should stay on the current course and then evaluate things. You agree or disagree with Mr. Summers, the former Treasury Secretary of the United States, who's been one of the chief critics of the Fed?
I was very much in line with Mr. Summers' thinking back in May to July. But I think what he's missing with this analysis, because he doesn't talk about quantitative tightening, because quantitative tightening has an effect, too, on things. Remember 2018 in December when we were on autopilot with both rate hikes and quantitative tightening, and they had to pivot almost immediately. So I think he's kind of missing that. Also, the big inflation pop that caused all this tremendous change in attitude at the Fed towards rate hikes was fueled primarily by the terrible CPI data of the first few months of this year. And so suddenly we went from very modest rate hike expectations to very big rate hike expectations. But of course what that means is those numbers are going to be rolling off. So while the CPI has been hanging out on the headline in the 8s and even got to 9.1, it's coming down next year. We'll end this year at around 7. We'll probably be at below 4.5 as a base case. Things can always change with commodities by the May reading. So I don't know. It just seems like if that's what's coming, you're getting the CPI rate down by a few hundred basis points, and we've got quantitative tightening. And the Fed did not say they're not raising rates. They quite frankly, they said they're going to raise them more than they thought maybe a few months ago.
But you think a slowdown is warranted for the very reasons you're suggesting, that you think inflation is going to roll over hard, like David Rosenberg has talked about in the last 24 hours or so, because of, in some part, the money supply coming down, that inflation is going to get crushed.
The money supply coming down is already a fact. It's not a prediction. It's something that's already percolating through. And the Fed raising these rates has inverted the curve. And the Fed got pretty frightened, I think, of how flat the 3-month to 18-month, which Jay Powell claims is his favorite yield curve analysis, how flat that got. So that all suggests to me that we're getting more, deeper into the process. And I think that Rosie is right, that when inflation starts to come down with all of this Fed activity, thanks to the M2 and the recent decline, which could be reversed, but so far recent decline in commodity prices, who thinks the inflation rate, well, the economists think the inflation rate is going to go from 8.2 today on the CPI to something like high twos, mid twos by the end of 2023. Some people even say 2% by 2023. And then the weird part of the forecast is they say it's going to stay there, right at 2 like a rock for the next many quarters, which is completely implausible in my view. If you're manipulating through policies a 7-point decline from peak to trough in the headline CPI in that compressed of a time frame, I think your chance of it stopping at 2 is very low.